confusion or misunderstanding about it. And let me show you, here's a perfect transition zone trade. On this candle, and really what's happening, and this is what we're looking to leverage, and when you understand that, and I did this in the webinar last night, but I just want to review it so everybody in the room understands. You get a pullback on your trading chart. Price is moving up. But as your trading chart price moves up, the price on the two higher time frames is moving down. Because you get this transition zone right here. So this is the most powerful transition zone that we can get. Now the criteria for getting an entry are the 50 must be yellow or red. The modified 15 must be below the 50. And then you want to get in a pullback entry as early in the zone as possible, optimally less than 5 candles into the zone. Most importantly, and the trades that work the best are trades like this, where the pullback on your trading chart creates the down zone, or the most powerful down zone, and you're in at the bottom. This is a very, very easy. No, I don't think this went 38. And let me see if this took you out. Well, you'll be taking that right here. So this would have been a 38-tick trade on a 15-tick trailer. You lock in 7 ticks on the first contract, and then you're going to give back 15 here. So you're going to get 23. So this is going to be a $300 trade on 2 contracts. You can take it out anytime you like, even if you're on the algorithmic entry. If you're up 300, if you're up 25 or 30 ticks, remember you got to make 15 ticks. If you close the trade on a discretionary basis at 30 ticks, you got to make 45 if you let the trade run. So it's always a consideration. If you're up 30 or you're up 35, you have the 7 locked in. Now you're now up $420 on 2 contracts. Now here we get a transition zone, but you see that on the pullback candle, the modified 15 is yellow, and we do not trade a yellow modified 15 when the pullback occurs to resistance. And then the trade goes too far into the zone to even consider taking a trade. And that's what was so powerful about this. Now we want the MA diff to be small, except when the first candle creates the zone. You almost always get a very, very powerful move to the downside. That's why it's difficult to catch, because the zone hasn't been created yet, and the down candle is what triggers the background color. And it usually doesn't occur on candle close. It usually occurs intra-candle. So you can see that yellow background flickering. And so this was at crude inventory report. It would have been hard. What's it, crude inventory? Yeah, 10:30. But that would have been 55 ticks to the downside. Now, let's see here. Here's your entry here. And that's going to come back exactly 15, but this is occurring at midnight. So let's take the times where the where we've got decent volume. And let's see here. Here's the transition zone. Here's the pullback. Now you don't know what's going to happen. So you're in right here to the downside. Right here. Now your entry's here. That comes back 14, which seems to be a magic number. We see that over and over again. It comes 14 against you. Now remember, oh, that's going to stop you out. In fact, that's one of the few losers I found. Now we have no entry here. And here's another entry. There's the first retracement in the zone. You're 1, 2, 3, 4, 5. You want to be 5 or less, but the algorithmic won't trigger this. This is a discretionary entry. And you're in. And that's going to go up 59 ticks. The risk to reward on this trade is just extraordinarily good. And that's a perfect entry. It's a little risky to take on 4 contracts as a retracement because it's a multi-candle retracement. But to take on a transition zone trade, the risk to reward is with you. Now here, this is way, way off support. This is also way, way off support. But here's the thing. On this candle, you don't get the first candle as the entry candle on the transition zone. And what I found from looking at months and months of these is when the zone is created by the first candle that pulls back and the first candle signals that you have multi-time frame alignment, you almost always get at least a first target. And this one goes up 29 ticks. I'll just show a couple more. But I know because people were asking in the room today, was there a transition zone? And there's no transition zone here. Here's your transition zone trade right here. Your entry is here. Trade goes 11. Once it goes 10, you're locked in $20 of profit. So the trade does come back against you. It's going to take you out at -5, but you're locked in 3 here. And the trade goes to, let me see, when it goes to 10, you lock in $20 of profit. Here's another one. When they occur, when the pullback goes into the zone, and the first entry is the color change, those are the most stellar trades I've ever seen. Really. Because you're in 1 tick below the close, and down you go. Now that's 34. So you're going to give back 15 if you let the trade run all the way to the bottom, and then you let the trade come all the way back. You're going to wind up with 19, and you're going to wind up with 7. So you're going to get $260 on that trade. And only 2 contracts. That's a really, really nice reward on a small amount of risk. There's really no retracement back here. Really no retracement back here either. Now that's way too far. The MA diff is too big. 1, 2, 3, 4, 5. This is, you know, you're extending it. But on a discretionary trade, this is a very, very, very nice transition zone. That first pullback after the zone occurs, very, very rarely are you going to get a loser. And this one goes 45 ticks before it takes you out. So you make 30 and 7, $370 on this move. That's only 3 ticks less on of profit on 2 contracts than you would make on 4 contracts, taking, although on paper it's twice the risk, it's actually much less if you realize that all you need to go is 7. And I'd say 90% or more of these trades go at least 7. And once you go 7, the most you can lose on the trade is $20. Because you've locked in 7, and if you come back and get stopped out, the worst that can happen to you on the remaining trade is you lose 10 on the remaining contract, but you've made 7, so you lose $30. Now here, there's no retracement. This is just a traditional trade. Here it is again, right here, on the zone. It creates the trade, and you can see that the MA diff is small. Now the other thing is that's non-discretionary is you take the trade out at a pivot. This one's 16, so you get 16 and 7. You get 23 ticks or $230. You can see how conservative. We never will anticipate that a pivot will break. We're always going to take them out, and the algorithmic will take it out at downside pivot support or upside pivot resistance. Now this is a little bit far. Take it. I mean, it is an engulfing candle. It's 1, 2, 3, 4, 5, 6. It's pushing it a little bit, but it really, you know, the algorithmic won't go 5 or more. If you wanted to take this, I mean, the risk to reward on these are so good that, and actually, this is your first retracement candle, but you can't take it because it's trading into a pivot. You have to wait till the pivot breaks, and that's your first entry on a pullback after the pivot's broken, because this candle breaks the pivot. You get a full body candle close below, and here's your entry. It's a little bit riskier, but unlike a trade even on 2 contracts looking for 5 ticks, the metrics of this make it less risky. And this trade is going to go all the way down for 78 ticks. So let's just look at today. And I'll show you why we did not have one today. Because there are 2 things that you must have when you take a transition zone. Now, we got into this trade. And one of the reasons I took it was because the zone was created on a retracement candle. And I took it with 2, and it went all the way. We made $200. If we would have taken it as a transition zone trade, well, we couldn't take it as a transition zone because of the fact that the 15 on the candle had not crossed the 50. And that's an absolute must. Now, I was watching the trade, and the candle and the modified 15 was close, but it did not appear to me that it had crossed it until we got to this candle. And this candle is what moved it through. But when I see the transition zone on a pullback, I either have the option of taking it as an entry, which I did, or taking it as a transition zone, but this broke that rule. It's very close. Now, we made more money on this trade taking the two because we had targets. On the transition zone, we would have come back 15, and it would have taken away a lot of money from us. And the reason is this was so far off support or resistance, and also possibly because the 15 hadn't crossed the 50. So there just wasn't a zone trade here. And that was the only opportunity. On the E-mini, we never take a transition zone trade on a yellow modified 15. And that's what we got this morning. Now there's the transition zone right here. Now we still need, what we want to see is this color change occur on a candle that's actually pulling back. Price is pulling back, but our two higher time frames, which are the 8 and the 13 range on the E-mini, are continuing to move down. This is just chasing the trade down, and there's no way this is not a transition zone trade. And that was it. We don't even have, I mean, the E-mini's still recovering in price, but that was the only period where we can take a trade. Now in the early morning, this is just too high of an MA diff. Too big. Now for all the transition zone trades, you want the MA diff to be 7 or less, unless the zone occurs on the first candle, which is a pullback candle. Now we have the algorithmic system set to take an entry with an MA diff of 30 if the entry candle occurs on the first pullback, because it's such a powerful signal. And really, I had to sit down and look at this for weeks and weeks, and we ran 2 years of market replay data to see on the transition zone, when you go to green on a pullback move, the ability to move up on almost every market is incredibly powerful. And here it is right here. This is not a well-configured. Well, the other thing is you must have triple quants. There's no triple quants here, and you have no trade. Now, this was a potential transition zone. The algo took it, and it's 1, 2, 3, 5 candles in. All 3 of the quants are green, and on a transition zone, this would have gone 6.25 points. Now, over Labor Day, we're going to work, and we're going to figure out exactly how much of a pullback we need to take us out, what our first target's going to be, and that's all we need. But you're going to see lots and lots of trades on crude come back 14, but not the 15th. That's why we set it at 15. So right now we're working on that, and we'll have it configured when we come back on Monday and have it programmed and ready to go on the E-mini. Now we're also going to be adding the NASDAQ. Let me show you the NASDAQ today. Here's your transition zone on the NASDAQ, right here. There's your pullback. And here's your triple quants. Now, if we didn't get them, you're not going to get the trade. But now this is the trade that the algorithmic system took for 12 to the downside. But that's really close. This may be where the middle quant is yellow, but this is what we're looking for. And the trade is so powerful that we don't look at the NASDAQ, but you can see what happened. The NASDAQ, if we traded it ourselves, would have gone from all the way down to here, would have gone 8 points. And we'll have the NASDAQ up really shortly. And the NASDAQ is very difficult to trade. It's very whippy. There's no background bias at all here. No, it can't be. Here it is. I would never take this as a conventional trend trade. It's too far in. 1, 2, 3, 4, 5. It's too far in. You see here, there's no quant alignment, no trade. No quant alignment, no trade. See, this you can't know, but there's no quant alignment here, no trade. No quant alignment, no trade. That's as far as we go back on the NASDAQ. When you get a trade, it's going to run. And I'll show you gold. Gold is really tough to trade. But on this system, it really comes in with beautiful winners. There it is. The only problem is you got to pivot. And you don't take a trade into an unbroken pivot, so there's no trade. Now this trade here is 1, 2, 3, 4. The thing about gold is we're going to have to set the ATM and the algo much more conservatively. There's your transition zone, and you get the move up. Now this data has been rolled over to the right, because I've opened and closed the Ninja since this data was created. The zone is going to occur on this candle. Because NinjaTrader pushes everything a candle to the right because it's a fractal indicator. We would have had an entry here. Now, we don't know the exact ATMs yet. We're working on that. But that definitely would have locked in your $30 profit. It wouldn't have been a big, and here's your beautiful entry right here. It'll go down 22 ticks. Now, I don't know if we're going to take a 15-tick runner. I have to see about that. Let's see, from here to here, it comes back 12. So you do go all the way to 22. And let's see where market profile is on that move down. Because the trade may have been halted by the value area low. The trade is going to be taken out at any area of downside support or upside resistance automatically. Now you just don't get a pullback here, unfortunately. You just get a move all the way down. So you get the pullback, but the algo wouldn't take it because the candle's 2/3 above the modified 15, which means it's broken it to the upside. It would have given you a really, really nice trade down, but it's got that specificity. Now here, you would have been in here. So everything would have been rolled one tick over, and that would have been an entry on a pullback. Actually would have gone 8. I didn't scale it exactly right, but that 8 would have locked in, so your loss here would have been 30 bucks. And this is not on a pullback candle, it's just a move down with no entry here. Again, no pullback, just a move straight up. Now here's your pullback, right here. This is at 10 o'clock in the morning. It's early into the zone, and you can see how tough crude is to trade sometimes. It goes 5. It doesn't lock in anything. But here's the other rule that really protects you. You always are going to close on a down close. So if you haven't locked in any profit, your exit is always going to be the first down candle. Once you lock in profit, then you'll allow the trade to run. Until you get to 7 ticks and your stop moves and you lock in a maximum loss of $30, this is going to close you out here. So it's going to close you out at minus a tick. So all you're going to lose is $20 on this trade. That's what makes the risk to reward so great. And see, this is what makes crude so hard. This goes 9 and then comes back, and you're going to lose $30. Now this one on gold is a little too far in. I want them real quick on gold because gold's the toughest of the instruments. So when we get a winner on gold, they can be enormously long, and we really look to limit our losers. That's what makes the risk to reward so great. So gold is the hardest instrument. We're going to set it the tightest. But there's your perfect entry. There's your 22 ticks. And what's really nice about the trade is one winner will take out 5, 6, 7 losers. Because you rarely, if ever, take a full loss. Even if it moves up 5 or 6, you're out on a reversal candle. And that reversal candle is really going to limit your downside. So that's a transition zone trade. And it can be traded on the algorithmic electronically where I don't do anything, or I can take a discretionary algorithmic entry anytime. Now, anytime I hear the electronic entry trigger, I'm going to grab the trade because it's taking the most conservative entries. But I have an electronic dashboard. It's not up right now because we clicked it out because we didn't want it firing into the afternoon when no one's watching it. But I think what we're going to do is we're going to let it run 24/7. And the trades are so conservative that if you have the margin ability to trade into the night, you can do it. You can see right now, you're never going to get a transition zone on crude. The algorithmic is gone. Background bias is gone. Institutional trading participation is gone. The same thing with the E-mini. Now, if that should change at some point later in the day, and you get a really nice setup, even if it's moving slowly, you can still take the trade. So if you have the margin, you can trade. You can leave the system on crude and on the E-mini, eventually also on the NASDAQ and on gold, and trade it all the time because the risk reward is so terrific. When it sets up and you get an electronic entry, which are the most conservative, you're going to get nice entries. But it's not going to give away a tick for you, And if the 15 is not below the 50, you're just not going to get it. And the biggest giveaway, though, on the electronic or the algorithmic system is if the color change occurs on the first candle, it'll allow an MA diff at 30 on crude. That's a huge MA diff. But that transition is so powerful, you're almost always going to make it to 7. And then your risk on the trade is a lousy $30. And your potential upside is still 20 or 30 or 40 ticks. So your risk to reward is still great, even with an extended MA diff. And it's how we can get into a trade where the market just keeps moving up and up and up, or down and down and down, and we just can't get in, but we just need a break in the zone. And they occur. Because this indicator, the modified 15, it tracks. It's not only a moving average, but if you'll notice, it's also very much linked to momentum. And as momentum wanes, the modified 15 goes flat. It's not just a moving average. It's a component of two separate indicator processes. So, and once momentum ends on your trading chart, you can see how price goes into chop. That's why it's so important for the modified 15 to be in your favor, or to have the quant line in your favor, or background bias in your favor, or background bias in the quant. But the modified 15 is a significant independent variable in taking a successful trade. So once this goes flat, you lose a very important independent variable. So the algorithmic system will not take a trade on a flat modified 15. And anytime we do in the room, it's always associated with a little bit more risk. See, this one failed. We did have the quant. We did have background bias. We had everything. And even though we didn't have the modified 15, and it was an important independent variable, this was still a nice trade. And this was a rollover. And actually, the entry was right here. And you see that's a transition zone entry, except the 15 hadn't crossed the 50, so we had to take it just as a pullback trade. But we got the zone, and that's the only reason I took the trade. Notice how far this trade is off of resistance. It's 9 ticks off resistance. It's a full candle. Normally, you don't take a trade 9 ticks off of resistance. But this trade we did take because the zone was created on a move to the upside. And this was just a continuation trade on a falling channel. Even though we had the modified 15 yellow, it still worked nicely. It went 11 ticks. And you'll notice here, I didn't take the trade. But here's the move down, and here's a retracement to resistance and the continuation trade to the downside. That's definitely a tradable entry right here. This is just a riskier entry. But any trade into the trend with background bias, pink, and the quant line red are the kind of trades we want to take. So if this trade failed, you still have very nice rationale for taking the trade. It's also a falling channel right here. The bulls can't push the price up as high as it was here. And it fails right at resistance on the channel and rolls to the downside. And that's what we're looking for. So what I'm going to do is I'm going to bring up a new chart. Of crude with no indicators. Now, if you really want to be able to successfully trade, you really have to know how to, you really have to understand this. Now, I got wed to the counter trend trade, and we got some really great ones. But on balance, it's really hurt us more than it's helped us. And this is just with the, we don't want to look at these right now. The reason we don't have, we use chart trader instead of this, because when you're trading, it really does make your chart a mess. Now, I'll tell you one other thing too. Okay, there are people who trade pure price action. Now, pure price action I don't know why these candles are, I think they're too thick. Here we go. Now, when you trade pure price action, trust me when I tell you, you cannot do it. You're going to get some nice trades, but you're going to lose many more times than you win. And here's the thing. Now, when you trade pure price action, you pay no respect to any 50, any 15, any overbought or oversold signals. All you're doing is you're trading price. Now, let me make the wick bigger here so we can see it. Because on a channel trade, or a double top or a double bottom, it's the only time that the wick is important. All the other times that we trade, the only thing that matters is the candle body. That's a little thick, but that's okay. That's too, let me just make it bigger. And that's too big. Okay, this is a little bit better. Now, let's bring it in a little bit. And now, if we look at just trading pure price action, here is the move high. This is the swing high pivot. Now, once you establish a downtrend, and a downtrend is defined as any two red candles in a row to establish a downtrend. Any two green candles in a row establish an uptrend. So we have so the downtrend and the uptrend continually shift. Remember that pure price action traders don't have a 50, don't have a 15. All they're looking at is candlesticks. So right here, we have a downtrend. Here is where the uptrend starts, because we have two green candles in a row. But what we have here is the falling channel. And we're looking for the move down, and we get it. Now we have the uptrend, we have the pullback, and here is a double bottom. And you're going to take the move to the upside. Here, we don't have a downtrend established because we only have one red candle, and here's the first place you can take the short, right here. Here's the downtrend starts. Here's the pullback. The downtrend remains intact. And depending upon what your ATM is, you have the move all the way to the downside. The problem is that a lot of these trades don't work. And you can see, excuse me, I'm sorry. And you can see what happens if you just trade pure price action right here. Now, actually, this is a falling channel, so you're not going to go long. Here's a rising channel. You're not going to go short. Here's your move to the downside, and you're going to get that short. I know it's confusing, but you can only take a trade. Here's the move up, here's the retracement, and here's the move up. Now you can see that this is a counter trend trade. You've definitely established a downtrend. You move up, you retrace, and up you go. So here the counter trend trade works. If we had the 15 and the 50 up here, and we'll put them in just for the heck of it, you'll see that they're going to be definitely on the wrong side. See? You're taking a counter trend trade, but that's the way they trade. Now you're in an uptrend here, and you can't go short here. Here's where you establish a downtrend. And what you're doing now is you're looking for a move to the downside. Here's your falling channel for a continuation trade to the downside. And where does it go? Nowhere. Comes right back up and stops you out. Here's your move down. Here's your retracement. You're into the downside and doesn't go anywhere. So you can see a lot of these trades fail when you trade pure price action. We wouldn't take these trades because the 15 is above the 50. We trade price action and market structure. So I just want you to see the difference and the importance of this. And that is, you're going to see a lot of people say they trade price action. If they do trade pure price action, there's no indicators, there's no 15, there's no 50, there's nothing. There's just price. Now, every place that I've looked, and it's hard to get this information, define a trend as any two candles of the same color in the same direction. So pure price action does not work. But if you add the 15 and the 50, then you're trading price action plus market structure. Now, once you add market structure, then a lot of the winning trades that you see, like right here, and I'm going to clear the chart of all the stuff we drew on. We can't take this trade because it's a counter trend. Now we have trend. So we have an indicator, and we can't trade the counter trend direction. But we can take this as a potential rollover because of the slope of the 50. And we get to look at other time frames, just the 15 and the 50. And also, now we get to trade channels in the direction of the trend, which is of the 15 and the 50. Here's your down channel. You enter here, and you get a first target. But it's risky because you have the same thing here. You don't go anywhere. This is why you want to take the trades only when the 15 has crossed the 50. And you'll see here, this is even though they're red candles, this is a higher high. So you have no down channel. And this is a risky trade. It can be taken because you're taking it into the trend, but you don't have the 15 below the 50 again. Now we know this trade, and we know this is a terrific trade to the downside. It's based on market structure and price action. But look That's what's happening to the 15 and the 50. You have a falling channel. And when there's a falling channel into the trend, they're very powerful. And if you took the trade short here, the trade would have never stopped you out. Would have come back 8 and then given you this big move to the downside. So you want to take channels into the trend, but you want the 15 and the 50, what the 15 below the 50, and optimally the 15 and the 50 red. And we're going to go over those setups. Let me just load 20 days of data. Just give it a second to load. Okay. You know what? Let's just go back to here. And we'll start taking them. Now this is just a continuation trade. Here's consolidation. Now we've taken out market profile, we've taken out the pivots. You have a move up. Consolidation. A move up. So you have 3 entries here. One's here, one's here, and one's here. The entry occurs, and this is why I know somebody asked me to put the pointer, but the crosshair really helps me a lot better because I can move down and see the time. This is 9:03, 3 minutes after the pit open, which is enough time to give it a chance to settle down. And you can see, if we would have taken these 3 trades, this is on 8:15. I don't know how we did that day, but I don't think we made this much money. We would have been finished here. This is going to go to here, 11. That's $250 on 4 contracts. This is going to go here. That's 19. That's 1 tick short of 400. It's going to be 300 and change. And then you take that, and you have 25, and that's 400. That's 400. That's about a 100. That's about a $1,000 move right there. Just hold on 1 second. I just got my son just texted me. Text me. I'm sorry. Excuse me. I just want you to see how okay, I'm done. Okay, I'm sorry. Okay, so let's take a look at another trade. Now, remember, these are all into the trend. Here's the rising channel, right here. Here's your entry. And here's your winner. Here's your retracement and your winner. Retracement out of consolidation and your winner. And And then really the trend is over. Now if you take this area of consolidation here, you're going to have to take this entry, and the entry needs to be either an engulfing candle to the upside. We want to get a piercing candle. To the downside, we want to get a dark cloud cover. If you don't know what those are, on a piercing candle, the candle body of your entry candle has to go move within at least 1/2 of the candle body of the previous candle to the upside, or come down and move 1/2 into the body of the previous candle on a short trade. So we have nothing. The modified 15 goes yellow, and our trades are over. And you see, you can't take this because this is a lower low. And there's no way to know that the market's going to come up. So it doesn't matter. We just take the retracement, and then we move up. Now, can we take this trade on a rising channel into the trend? We can, and it's a winner. Can we take this trade? No. You know, you can if you want to take a double bottom. But I've really found that I like the rising channels better, because these show that the power of the bears here are waning. They're trying to push the market down, and they can't push it down as far on the second, on this candle, as they did here. And I think a double bottom is a powerful signal, but I think this is a more powerful signal. So you make higher lows and higher highs. Your entry is here, and yet another winner. And then you just, this is a really nice trend trade, comes up, gives you some acid indigestion, doesn't stop out, and then up it goes. Now, if it gave us a first target here, would it come back and stop this out at break even after a first target? And here I think you're a little bit overextended. Now, the only other thing that I think that is important for you to count is the number of retracements in a given trend. So now here's another move to the downside. You'll notice that all the trades that we're taking, the 15 is on the appropriate side of the trade. Out of consolidation to the downside. Now when you trade like this, it's hard to find the loser. Now you're on a yellow modified 15, but here's your rising channel. You're in, and up you go. That's a $400 trade. It's late in the day, but it works. So let's skip through the night and move to the morning on the next day. Now we're only going to look at long trades when we have the 15 on the appropriate side of the 50. And here we're trading price action and market structure. We're not taking a short below the 50 I'm sorry, we're not taking a short above the 50 or a long below the 50. And the other piece of information that we must have is that the 15 and the 50 must be green. We're always taking the trades on the appropriate side. Now this is way off support, and I wouldn't take this trade. But you can see how if you did, you have a winner. Now this is a nice trade. It's really not out of consolidation. It's just a retracement. And at the time, the 15 is above the 50. So this is not a short trade. And you can see, I'm sure the higher time frames haven't rolled, and the anticipation was for a move up. And this was risky. When the 15 is above the 50 like this, and the 50 just starts to roll, you can just read right off your trading chart that in all likelihood your higher time frames haven't come into sync without even having background bias. Now what we're going to do in a second, I'll show you what we're going to do. Look at this move. Now, I don't know what time this occurred. This is a multi-candle retracement, so it's riskier. We're just trading price action. We're trading this retracement. And you can come all the way down to here, and you can see that you have, and it's very hard, you know, when I trade two instruments, it's very, very difficult to see. But what you're doing is you're really trading in this channel right here. And these are real. I mean, you don't manufacture them. The market is making higher highs and higher lows here, here, and here. And when you get this pullback, if you trade one instrument, you can see this much better. And this also could give you the ability, although this is a very risky trade, on this slightly tighter channel to take a long here. Now, I think because we trade market structure and price action, you don't want to take a long with the 15 below the 50. Wait for this to align. Then you have your nice channel and your continuation, and up you go for this beautiful trade. Now, the thing is, what you're looking for is reasons to take a trade or not take a trade. You don't let price action and market, you let price action and market structure give you an entry, and then you look at all the independent variables associated with it to determine whether or not you think it's associated with too much risk. And another reason is you also have this falling channel, and you don't know which way it's going to go. So on this move right at the 50, the best thing to do is stand aside, and it's best to stand aside on all the trades where the 15 is below the 50 on a long, and it's above the 50 on a short, because they're tough trades. But if you're looking for a reason to take this trade, one, it's an engulfing candle. That's market structure. That's actually price action. Market structure is the 15's above the 50, and the 50 is rolling to the upside. The fact that it's yellow is okay, as long as it isn't red. And the third thing is you've got a rising channel, and you don't always have that. So up you go, and you're out of sight. Now, it's easy to spot them in retrospect. What's harder is to spot them in real time. But if you don't miss these, you're going to do really, really well. And you see how it's very, very tough to find a loser. Now, what I'm going to do is I'm going to add bias. Now, remember, every time we add an indicator, we add specificity. They will help us narrow the type of trades that we take. They're going to limit our entries, but the trades that we do get should have a higher predictive value. So here's the bias. We don't have to do anything to this. It's going to, and you see, now this is actually going to be one candle over. Background bias confirms the long trade. Now here is where the 15 and the 50 are both moving to the upside. The 15's green, the 50's green. 15 and 50 are green on your two higher time frames, but the 15 hasn't crossed the 50 on your higher time frames. That's where you go to dark green. But this is just another independent variable to tell you this trade is going to move to the upside. Now, we can't take a short above the 50, so we're just looking for longs. And a move up. And you see, here's where you got to watch, because here's this rising channel. Now, it's not that smooth of a channel, but in no case, every case, higher high, higher high, higher high, Your entry happens to be a little bit of a lower high, but higher low, higher low. Everything's generally moving in a bullish direction. But here's the better trade anyway, right here. The retracement and the continuation. The retracement and the continuation. These are our bread and butter trades. Now this is after the trading room is closed. And this is 14:30 in the afternoon. And this is a drop we just can't get. This is way, way off resistance and we can't get it. But here's a great trade. This move down, this move up. I call it turning the corner on the 15. It breaks the 15 and immediately retraces back to it. And then you get this move all the way down. You're not going to get stopped out. Your entry is right here. Well, maybe you do. Let's see how far it goes. So it's hard to tell how the candles form. But let's see, when you hit this candle here, you're up 6. And this candle is going to come back and take you out of the trade. So you're going to get a first target. If it didn't go 6, if it went 4, this wouldn't have taken you out because your stop wouldn't have moved. That would have taken you out. Now we're way into the night, but look how this is moving. I mean, you're going to anticipate a break to the downside, but you don't. It's actually a loser. But you can see how you're going to be able to predict the direction. Now let's just move to when there's some kind of reasonable volume, and it's right here. Now this is also a very, very tough trade. I don't want to create trades where, even if I saw it. Now, first of all, let me just. Here's what the market looks like here, and this is not a trade we were going to get. And here's that turn of the corner. Breaks the 15, comes right back to the 15, and down you go. I mean, this is how close attention you got to pay to the charts, or you miss a lot of these entries. It doesn't matter that the 15 is yellow here. It turns red immediately. That break, an immediate retest. The next candle, it just swings around. When you get an engulfing candle to the downside, or you get a piercing candle, a dark cloud cover, this is a dark cloud cover, down you go. No way to call this bottom, and we're not doing that anymore. We're not taking any long trades below the 50. We have nothing here. You can trade this channel. Whoops. Call a move to the upside, but I think it's risky. If you're looking, I would be willing to bet we don't have a quant here. We don't have background bias. All it's doing is showing you the power of price action and market structure. If you look at this, this is a really nice rising channel here, and it calls this long here. I mean, there's really a story to be told in these candles if you pay close enough attention and you read it. And then here let me just refresh this. Now, even without background bias, see, this is your really nice trade here. I don't know what the MA diff is. It may be too far extended. See, I'm just going over this quickly. This is probably too far off resistance to take. I don't want to create trades just because they're successful. And look at this trade. This is late in the afternoon. This is 14:27. It's 2:27 in the afternoon. And that's a $400 trade. You see right here, if you take this along here, let me just refresh. You know, that's not a bad trade. It really isn't. But that's going to give you a loser. And we finally found one that just didn't follow through and didn't work. So let me just show you a couple of more channels. Into the trend, always. Look at this. See, these are the trades that are just hard to see. You're not going to take a trade until you break the 50. The first candle to break the 50 is this candle. You have weak background bias, and the 15's below the 50. So it's not a terrific set. It's also 3 o'clock in the morning. But you can see what happens. Up it goes. And I'm going to kill my son. Okay. Sorry about that. All right, now let's just change, because I think this is where we're going to close, and I'll look and see if there are any questions. Now this candle, you can't go long. Whoops, wrong button, because you're below the 15. But look at this. If you had any doubt about taking this retracement, you shouldn't. There's the move up. If you have any doubt about taking this retracement, and you might, because it's a multi-candle, not when you look at the channel. And up you go. And if you had any doubt about taking this move up, you had any doubt, up you go. You see how it helps confirm? Now, the only move up that needed confirmation really is the multi-candle retracement. It's this one. Now, the room is open here. It's 9:01. You have a minute and 45 seconds after the pit open. And the MA diff here is narrow. It's not big. Same thing here. And same thing here. This is 8:50, 10 minutes before the pit opens. Definitely a tradable entry. This is why we have to stop the counter trend trading and watch price action better. And here is a yellow modified 15. Now you could take the trade any place. You could take it here. Now remember, you're taking this on the strongest background bias. Doesn't work, but it doesn't stop you out, and up you go. This is where it pays to take risk, not on a counter trend trade, but in a move where the candles are telling you that the power of the bears is waning and the power of the bulls is gaining. Higher high, higher high, higher high, higher low, higher low, higher low. And then you have to include the wick. When you're looking at a channel, you're looking at a trend line, that's the only time you include the wick. When you're looking at engulfing candles and dark cloud covers, you don't include the wick. Only the candle body. So I think this is really what I wanted to show you. I wanted to clarify and right here again. Now this is very, very late at night. It's 23:14. It's a terrible time to trade, but even here, there's the entry. Now, again, when you take these, you could have entered here and wouldn't have stopped you out. You entered here on a green modified 15, just get less of a headache. And that's all. But the ultimate outcome is you actually make a couple of less ticks. So 620, 629, 636. I mean, you have to sit here and, but we're just showing the power of market structure and price action. I don't think it's a good idea to trade at 6 o'clock in the morning when there's no volume. So we can't take a short above the 50. We have to wait for that. We have to wait for the candles to, and what we're looking for here is a down move, and here's a loser. Here's the channel is making lower lows. You have your potential entry to the downside right here. There's nothing below you, and you don't make it. And the candle just doesn't follow through. Now, I think, I don't know if there was, let me see what day this is, the 19th? Let's see what was on the 19th. Nope, it was just a Friday. So that was a loser. If you traded this channel. Now, again, it's always best to trade a channel on a red 15. If you do, you're going to lose a couple of the winners I showed you, but you're going to bypass these losers. And here's noon. And let me see what the background is here. See, this is a really, really nice trade and no follow through. Right at 12:33. This is the Friday, and it's summer. In the afternoon, it goes 3, and yet you get collapse. So you have to be very, very careful. So we're going to stop. I just hope that you saw something that that maybe keyed something in your head. About what we're looking for in the moves and how you read price action and market structure. If you read price action alone, you're never going to make it. If you read price action and market structure, you will. And this is why people complain about indicators. On the E-mini, if you don't have the quant lines, you're dead. And the fact is that the background bias correlates with the quant lines to a very high degree. You don't get multi-time frame alignment unless the correlative markets are rolling in your favor. It's hard to get 3 time frames aligned in the same direction. The 15 and the 50 aligned in the same direction on 3 time frames. Because as I mentioned briefly last night, the market is a closed system via the laws of thermodynamics, just wants to move into a state of maximum chaos. And the only way to get it to align and move in a non-chaotic way to bring order to disorder is to bring in money. And money, institutional money, is what creates these multi-time frame alignments. And that's why they're so powerful when you get entries on them. And these are the bread and butter trades we just haven't seen. Now this is occurring again at this is occurring late in the day. Like this is your move down off a consolidation. We haven't seen a move off a consolidation like this in such a long time. And these are so great. Now we're going to see these after Labor Day a lot. And we're going to get them with the trend, with background bias, and we're going to jump all over them. And this is pure price action. We add the market structure of the 15 down, and the 50 down, and the 15 down, and that just increases the precision of our trading. It defines for us clearly the direction of the trend, rather than saying, okay, the trend is up now, and we're looking for a long trade. Now the trend is down, we're looking for a down trade. It's very difficult when you trade price action. So that's really it. Let me see if there are any questions. I hope it wasn't confusing. I just hope this gives you a better. Now, I don't have the trades from today, but I'm never too embarrassed to. Let's take a look at the trades from today quickly. Now, obviously, this was a counter trend that I'm never going to take again. The fact that I took it with 4 contracts added insult to injury. I only meant it to take it with 2. We still finished in the positive, but it took a lot of work to erase this 4 contract counter trend on a rising channel in the wrong direction, and it really hurt. This was not a bad trade. It's a falling channel with the quant, with background, and every now and then on a yellow 15 they're going to fail. That's the kind of loser you have to take and grin and bear it. There's nothing you can do about those. But that's a valid trade, and you don't have to alibi for it or anything. I mean, has a decent predictive value for winning. This also, because you're taking it on a falling channel, even though you don't have background bias or the quant, which makes it a lot more risky. You're taking at least it's a trend trade. And here was the transition zone. Only it was a transition zone we couldn't take, but I took the entry anyway. Here was the same trade I took that lost. Falling channel off a yellow 15, it went down. I didn't take the move down and the retracement to resistance. I was a little too concerned about it, but down it went. And then this was just an oversold move down. That went 8. 2 more ticks, it would have locked in more profit. So we didn't get that much. Now, after we closed, this was trading into a pivot, but we could have taken this trade. And this would have taken us down 10 ticks. And on 4 contracts would have locked in $250 more on that trade. And then here's another move on crude right here. Very, very simple trade. Just crude is moving so bad and on such poor volume. We don't want to take these trades because there aren't the number of contracts crossing. There aren't any. So this trade and this trade are extremely risky in a no volume environment. So crude didn't offer us that much to trade. The only thing I had to do, and I don't want to bang the table, is get rid of this, and we made $310 today. 280 plus the 30. That was all we needed, even with this 1 loss, which is almost a full loser. This is really 9 ticks, not 8. That's why we read the amount off the background. Off the control center, and we don't take what I scale. If you scale it, it may even scale at 9. Here's the entry, and here's 1 tick above the reversal candle. I'm just trying to get it right on. See, it scales at 8, but we got to take a slippage, and we really lost 9, so we lost $180, and that's what trading is. But all the others we got, all falling, or retracements, or falling channels, and a move back into resistance on a down trade. So I hope this brings more clarity to the trading, and also it brings more scrutiny on me not to take trades that don't conform to these rules. And these are our rules and regulations. And we're not taking any more counter trends. Now, I just want to mention for the record, and then we'll finish. And that is, There is one counter trend trade, and I have looked at it and looked at it and looked at it, and it still works, and it's still valid. And we just don't see it that often, and I'm trying to find it. And now that I'm looking for it, we'll probably never see it. It's the reason I have the wrong template up. I'm not going to, what it is, it's just simply a move up, as I mentioned. It comes right back to support, and then the move off of support is a C candle. Those C candles are very, very, very powerful. And when we get those, it can't be a dark cloud cover or a piercing candle. It's got to be a C, especially if it comes off of a yellow modified 15. And they almost always do, because you've got to move below the 15, then a move up, and then a retracement back to support, or a move down. If this is the modified 15 here, you get a move down, then a pullback, and then a continuation short above the 50. This must be a C candle. And I've looked at months of these entries, and when you get them, they almost always go to a first target. So that's the only counter trend trade we're going to take. We're never calling bottoms or tops again, ever. Even on a tight triple bottom like this. So I don't want to give up any money, and every penny is so important. And you see how unreliable it is. I had to close this at +4 to make money, and this didn't follow through. And then the trend trade goes 7, and that's why we just have to trade with the trend. Alrighty, now let me just see if there are any questions. Thank you, guys. Thank you very, very much. I'm telling you, this is not information you're going to get anyplace else. It really isn't. It's hard to find in any books. Nobody writes about it. All they do is write about, their junky indicators and all that stuff. But they don't write about the important stuff, and that is how to read price action and market structure. It's very, very difficult information to find. Now, everybody who is in the trading room, whether you're here and attending this or not, is going to get a copy of this. We're going to email it out to you. So you don't have to worry if you missed it or you fell asleep. You can listen to it again. And so listen, everyone have a really, really nice afternoon. And we'll be back tomorrow morning, and we're just going to look for the conservative trend trade and or moves out of consolidation and or moves out of a channel. That's it. No other trades. As soon as Leo finishes all the other stuff he's working on, which is getting the transition zone trade on the NASDAQ and getting it on gold, we're going to try to create an indicator that creates a channel automatically, just based off of higher highs and higher lows and higher highs, just like the consolidation indicator. I don't have it on the chart, but we have it here. Just like we were able to format a really nice consolidation signal right here. Now, obviously, we don't have quant verification here, so we have no trade. Here, we don't have quant verification, and the trade went anyway. Here we don't. See, I mean, occasionally you're going to have to give away a winner in order to avoid a ton of losers. But let me just, I think everybody has seen the consolidation indicator. And let me find a real nice one here. So you just don't get them in the summer The market doesn't trend for beans. See, I mean, here's a nice trade you ordinarily wouldn't take, but it's a move out of consolidation. It's very hard to read price action right here. But you can see here's the upper border of the channel. Here's the lower border of the channel. You have the major quant with you. It's a little bit risky because the 15's above, but you're on a falling channel as well as a trade out of consolidation. And it's my favorite indicator. I always pay attention to it. And here's the other trade. But you're trading right into the value area low. And so it doesn't work. But it's a really, really powerful signal. Also, the problem with that entry is it's pretty far off resistance. I'm not making excuses for it, believe me. Here's resistance. It's 3 ticks. You'd like 2. If you took this trade, the only thing you have to worry about is the value area low and right below it a pivot. And I wouldn't take this trade into a dual area of support. Even on triple quants, you have no guarantee it's going to break both areas of support, and it doesn't. But this is a really terrific signal, and we're going to try to build one for the channels. You have to define them, and then once we do, I think it's going to be pretty easy for you to get a long or a short entry out of a channel. So it's really not going to be that hard. 3 consecutive lower highs and 3 consecutive lower lows. We just have to define all the parameters like we did for the consolidation signal right here. And this one would have been a winner, even though it's a little bit risky. Just would have made 4. And you have your intermediate quant, which is the lower, and the minor quant, which is the middle. All right, everyone, have a great afternoon. We'll see everybody back here tomorrow for our last trading day before Labor Day. We get a 3-day break, and let's come back after Labor Day. And I really want to beat these markets up to death by taking our conservative trades out of on retracements, out of consolidation, out of channels, into the trend, and we're going to get lots of transition zones. Now, we're going to have an algorithmic system watching gold and the NASDAQ and watching the E-mini and crude, and we'll also be watching the E-mini and crude. And when we get them, we're going to jump all over them. So listen, everyone, again, great afternoon. See everyone tomorrow. Bye-bye.